Hello, everyone. Today on the Final Bar, I'm talking with Mark Newton from FundStrat Global Advisors. We'll talk about this broad market environment. It's a choppy experience being an equity investor. As I was talking to today's guest before we went live, it is in many ways just a beautiful stock picker's market. There are plenty of opportunities, plenty of names, and when I'm screening for stocks making new highs, I'm not struggling to find them. It's just that relationship between those individual names and a lot of strength versus the major benchmarks. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of StockCharts, using the technical analysis toolkit to better quantify investor behavior, better respect market history, and better understand market dynamics. This is a choppy tape. Yesterday, you saw plenty of strength going into the close. Today, you see a bit of the opposite in terms of a general downtrend through the course of the day. A nice bounce going into the close with the S&P just barely regaining 4,600. But overall, I think the open questions are: how well do you label, or how particularly do you label this run up that we've had in the major indexes? Do you call this a bear market rally, a brief move higher before a downtrend is resumed? Do you call this the beginning of the next leg higher as the S&P goes to 5,000 and more? Recently we surveyed a number of you whether the next 10% move in the S&P would be higher or lower. If I remember right, it was 40% said higher, 60% said lower, which means 6 out of 10 of you said we were more likely to break down through the February lows than we are to break above the highs from earlier this year. Interesting environment for sure. Now we have great guests on the show. I'm excited to talk to Mark Newton, who always does a great job sharing some perspective with us. Tomorrow on March 31st, we have Tim Tashler from Sprott Global. Next week, 2 really good guests to share with you. Author and trader Kathy Donnelly is joining us on the show April 5th. And Mike Zaccardi, who writes a new column on StockCharts.com related to financial advisors, is going to join us next Wednesday. He really focuses on how advisors can better use technical analysis to improve their decision-making skills. So really great guests coming along the way here. Let's continue on with our next segment, the market recap. Let's focus on what these markets are saying. Use charts to understand and to interpret, to respect the message that the markets provide back to us. The S&P 500, as I mentioned, closing just above 4,600. That 4,600 level was key. We talked about how important that was to break above that level. It is not lost on me that we finally closed above 4,600 yesterday, and we're right back trading below it today. Now, we did remain above it on a closing basis, but you really didn't get that follow-through, right? When you have a nice breakout like we did yesterday, I always look for validation, look for follow-through, indicating that there is further demand, not just the buying power that pushed us to that level, but do we have more in the tank to push us higher? As of today, I'm not seeing that. I'm seeing some distribution after breaking above resistance. The S&P down about 0.6%. The NASDAQ double that return to the downside, down 1.2%. Mid caps and small caps down as well, and both much more than the S&P. With the S&P 600 small cap index down almost 2%. The VIX is bouncing back higher, still below 20, and that 20 level is often one that, again, on an average year, if we have any of those ever again, 20 is sort of an interesting level to pay attention to. Are you above or below that key level? We're sort of right around there, and obviously we're much higher in the 30s just a couple weeks ago during the distribution phase on the markets. Some other asset classes here very quickly. Interest rates continue to come off today with the dollar sign TNX, that's the 10-year Treasury yield index, down around 236. Bond prices obviously higher as yields are coming down, and the dollar index is coming off. I'll share with you a little later a chart of the euro. One of my recent guests, Dale Pinkert, who was on the show a couple weeks ago, is really an FX guy, currency guy, was sharing with me his chart of the euro, and we were talking about a potential bounce there, what that might mean for euro strength, dollar weakness, what that could mean for gold. and some other asset classes as well. Speaking of precious metals, gold and silver both up. Gold a lot more than silver, which is essentially a zero for the day. Oil prices a little bit higher, and energy was the number one S&P sector today. Plenty of choppiness, as always, in the cryptocurrency markets. Bitcoin and Ether both down, although most of the coins that we track, these top 10 most liquid coins that we have on our dashboard page, were up today. Bitcoin and Ether down just a bit, and this is after a pretty good run, breaking out of a pretty significant basing pattern or a range on both of those charts. Let's look a bit at the chart of the S&P 500 here. So we spent a little bit of time on this yesterday, and we talked about this. There's certainly this rally and all of these signs along the way indicating not just a brief bounce, but something with a little more emphasis behind it. There are plenty of things recognizing or I think acknowledging that underlying strength. Things like the momentum improving, things like breaking above trendline resistance, previous swing highs, getting above the Fibonacci levels. 4550 was that last Fibonacci level to speak of. We've broken above all those resistance levels. The only one left were the February highs around 4,600. Now we finally closed above there yesterday. We gapped higher and closed near the highs of the day today. We're coming right back down and trading a bit lower. For candle fans, it's actually a bearish Harami pattern that I'm digging out of my CMT candle pattern playbook. I think that's right. It's been a while since I've been lobbing candle terms around, but a big up day, a big down day after that. Days to range open to close is a little narrower, so it's sort of kind of like a bearish engulfing pattern, but structured a little bit differently, and in general tends to be a short-term reversal signal. That would not be out of place if you had a brief pullback after this run, particularly in all the growth names. Now, that's the bullish argument or sort of the acknowledgement of the strength. Now, here's the problem I have with the chart of the S&P. What has really changed in the last couple of weeks from where we were in early March? I would argue not much. I would argue a lot of the same potential headwinds to equities going onward and ever upward from where they've come in the last couple of years all still exist. All of those challenges with economic data, with inflation, with the Fed and what they plan to do with interest rates, with geopolitical challenges. There are a lot of reasons why equities in general could be going lower. But in general, what I was taught by Paul Montgomery, the most bullish thing the market can do is go up. And as of the last couple of weeks, that's certainly been the short-term trend that we've been discussing. On an equity basis, number one sector today was energy, up 1.2%. We'll look here in a moment at some of the energy stocks because there are a lot of names that just continue to go higher. But sector number two, utilities, followed by healthcare. Everything else is sort of flat to down on the day. And at the bottom of the list, you sort of have an inversion of what we saw yesterday. Now, yesterday you saw growth stocks pounding to the upside. Things like technology, consumer discretionary, those all at the bottom today. So the growthy stuff, the stuff that's really been leading during these last couple of weeks, all at the bottom, giving back some of those previous gains. But again, not much. We still didn't even undercut essentially the lows of the last couple days. Right, we're still mid-range for this week. I just wanted to mention a couple of the energy stocks, and you can see down here some of the stocks that are in the biggest gainers for the S&P today. About half of these are energy names as I'm quickly glancing down there, but a number of other sectors are represented here as well. You know, MPC, PSX, it's Phillips, and others have a good, I think, representation of what the sectors sort of look like. You know, if you look at the chart of MPC, doesn't really look like the market's been having any trouble, right? And that isn't always an interesting phenomenon. I like looking at charts or recognizing charts where they show strength through a period of market instability. I remember coming out of the March 2020 lows, charts like Microsoft, that if you didn't know the market had gone through a period of turmoil, those charts really wouldn't suggest it because they'd just been in these nice, steady trends. And they'd given back some of their previous gains. But MPC, for example, Valero, some of the other names in the sector that have had really good runs, really didn't do a lot of damage from a technical perspective. MPC has consistently put in higher lows in the last 6 months, right? So if you go back to mid-2021, we've put in a fairly consistent pattern of higher lows. Most recently here in mid-March, we pulled back to the 50-day moving average and now rotating higher, making a new 52-week high again today. I mentioned some of those other names like VLO and others, which are the top performers in the S&P today, showing some renewed signs of strength. Healthcare as well, and there's some really good charts in the healthcare space. I was screening for stocks making new swing highs and new swing lows earlier today. I had about 150 large and mid-cap names making a new swing high, making a new 3-month high. You know how many stocks were making a new low today? 6. That's it, 150 to 6. That's how much it's been skewed towards stocks that are working. So while the major benchmarks have been struggling at times, there are plenty of names that are kind of working. And charts like UNH are interesting ones. I'm focused on UNH. I mentioned it a number of times in the last week because we recorded our 2022 edition of Chart Madness last week. It was Grayson Rose, Tom Bowley, Greg Schnell, and I had a bracket of the 16 largest listed names in the U.S. We seeded the bracket based on their market caps and literally did a stock picking bracketology exercise. UNH was one of the finalists. It was one of the potential champions or proposed champions from those 4 experts. And I get the argument. It was not me. I did not pick this chart, but I get the argument. And what you see here, again, from a technical perspective, a basing pattern in 2021 resolving to the upside. In 2022, sideways trend, breaking to the upside, getting above 500. Can a chart like this hold 500? That's a good trend and a strong chart showing improving price characteristics. That is our market recap. I want to take a moment before the break and revisit an early segment we used to do a lot, which I love doing and I miss doing. And here it is, the mystery chart. This is a chart. I will tell you, it is a U.S. listed security. It is either a stock or an ETF. We're looking at a 2-year daily open, high, low, close chart, 50 and 200-day moving averages. Some of these lines on here are my own drawings. At the bottom, we have the relative strength of this thing versus the S&P 500. So you can see it's been downtrending fairly consistently until November of last year, rotating back to the upside. My question to you, what is this mystery chart? A little later, after my discussion with Mark Newton after the break, I will unveil what this mystery chart is and why it should be a key area of focus for all of you. We'll take a quick break. We'll be back with today's guest, Mark Newton. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We really appreciate you joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. A couple quick comments before we get to today's guest, Mark Newton. First off, we did a mailbag segment yesterday. We'll do another one at the end of this week, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag segment Friday of this week. Also, go to StockChartsTV.com. It is for free. You can access great guest commentary, featured guests, people like Mark Newton and others that really know the technical toolkit and how to apply it. Special events like Chart Madness, our Market Outlook series from Larry Williams, Martin Pring, and many others earlier this year. So much more, all for free at StockChartsTV.com. Or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Mark Newton, joining us on the show once again. Mark's a managing director, head of technical strategies at FundStrat Global Advisors based in New York. Mark, it's great to see you. Welcome back to the show.
Likewise, Dave. It's always great to be back and see you again.
So a fascinating market, and my fellow technical analysts and peers in the industry, as we've talked, it's been a fascinating experience year to date. Seeing the relationship between the major indexes and a lot of individual names that are showing underlying strength and weaknesses. You're showing us a couple charts that I think tell that story beautifully. We're starting with a technology ETF, RYT. Talk us through this one if you could.
So this is interesting because I normally like to strip out the large cap stocks that make up the broader ETFs and really concentrate on the equal weighted ETFs. This is RYT, which is the Invesco Equal Weighted Technology ETF. And on the top, you do see that noticeable breakdown, which happened back in January. That's a time when many of the large cap technology and discretionary games, as the so-called FANG stocks, started to really fall out of bed. And on the bottom, I think, is even more important. So that's really a 3-year break of an uptrend of technology versus the S&P. And that also happened around the same time frame. But what's interesting is that on our recent little rally over the last couple weeks, we haven't really seen this rally back and regain that area of importance. And so there certainly has been, great movement out of stocks like Apple, which have set records for being up 12 days in a row, and certainly other stocks within technology. But the broader tech space still lagging quite a bit. So that is a little bit of a headwind in terms of how I view the market, so to speak, given that technology continues to be about 28% of the S&P.
I feel myself as you're talking, Mark, jotting down, look at more equal weighted indexes and ETFs because it tells
Right.
such a different story than some of the cap weighted charts we're used to. Your second chart is looking at the utilities sector. How does this compare?
Yeah, so this is exactly a reciprocal of what we saw with technology. Utilities have just broken back out to new all-time highs, and this is happening on a monthly chart. So this goes back and it made an all-time high back in February of 2020. And as of the month of March, the end of the month and the quarter, with literally a day remaining, this is now set to break out to new all-time highs on a monthly close. That is significant. It's bullish, and it's interesting that this is happening, particularly in the wake of interest rates, rallying very sharply across the board on really across the curve. The bottom part of the chart shows a couple different things. One is just a relative chart of utilities versus the S&P, and yes, the longer term downtrend is still intact, but yet we have broken back out above nearly a 2-year downtrend and relative performance of Utes versus the S&P. So that is a positive development, and the bottom half, even below that, shows just a simple MACD, or moving average convergence divergence indicator, on a monthly basis, and a very bullish, strong crossover. And historically, you look back at times that's happened back in the latter part of 2018, or 2013, 2014, which proved to be very choppy times for the market in general. So I like this group. I think that utilities should be overweighted, along with, as you discussed earlier, healthcare. I think that's very interesting. Technology is right now a mixed picture, and I'm really awaiting evidence that this can show evidence of rallying back. But it seems very interesting, but compelling, that there is a big push into the defensive groups, and it makes a lot of sense with what we saw in January, February. But in March now, with a rally of about 10% in 11 trading days, we look back at those groups that have outperformed over the last month, and we still have utilities and REITs that are outperforming technology. So that's very interesting to me.
Mark, these are two fantastic charts, and I couldn't have scripted. So everyone's clear. I did not ask or tell you what kind of charts to bring. These are ones you brought, and you brought longer term charts. I'd love to ask you. I think a lot of individual investors struggle in this sort of environment because you see such strength out of the lows, and there's this FOMO, this fear of missing out. How do you relate or deal with the short term strength relative to the longer term trends and stay centered when there's a bit of a disagreement there between the two?
Yeah, really, a lot of it depends on one's risk tolerance and time frame for
Mm.
investing. And you have to look at these leading groups like technology, which right now does not really seem to be participating as robustly off the lows. Financials also has been struggling a bit, even with rates pushing up, and some of that is those money center banks and investment banks that have rolled over in the in the wake of the recent Russian invasion. And so that's interesting. There are parts of financials, of course, that are working well, insurance and really regional
Mm.
banks. But when big groups like technology and financials aren't working, and you see a short-term rally of about 10% to near-term overbought conditions, when weekly and monthly MACD are negative on the indices, it makes you view the rally with a little bit of skepticism, and really a need for it to prove itself a bit more. So that's where I stand. I'm certainly open to all outcomes, but concentrating on the day-to-day S&P is not as meaningful when there's so many stocks that are doing quite well. As you mentioned earlier, the correlations have dropped to quite low levels, and so there's a number of different subsectors within various areas of the market that are still hitting new highs and act just fine.
It's a great comment there at the end about correlations, Mark, and very well said. Listen, Mark Newton, it's great to see you. Thanks so much for sharing your expertise with us. Stay safe, be well there in New York, and we'll talk to you again soon.
Likewise, David. Thank you. Be well.
That's Mark Newton. Mark's managing director, head of technical strategy at FundStrat Global Advisors, based in New York. And I would tell you, from my experience working on the institutional buy side at a large money management firm, talking with guys like Mark regularly is something I miss. I don't miss everything, but I definitely miss being able to talk with guys like Mark who are just really knowledgeable. If you caught, by the way, looking at this market with short-term strength, the things that Mark brought to sort of tell the story of the market, one weekly chart, one monthly chart, looking at the big long-term shifts, the rotations, and what's most important there. I think his comment at the end about correlations is a really good one. I think we'll try and revisit that down the road if we could. Let's continue on with our next segment. This is another one we haven't done in quite some time. We're going to bring it back here called Power Up. One of the things we like to do is just visit some of the key components of the StockCharts platform, things that I find are underutilized, are underappreciated, and could add some value as you're trying to make sense of things. A lot of the things we'll talk about in this segment in the coming weeks and months are under the Charts and Tools tab at the top of our website. So if you've not poked around there in a while, I would encourage you to do that. A lot of these are featured on the left. They're all listed out on the right side, and we'll hit on some of these over the course of time. The one we're going to talk about today is called the GalleryView, and the reason why I'm bringing it up is when we recorded Chart Madness last week, we spent most of the time using this GalleryView to compare two different things. Now you can click on it on the right or at the top. You can switch where it says Sharp Chart and switch it to GalleryView. What I'm going to do is just bring up a chart UNH. This is a healthcare name. We mentioned it earlier, and Mark and I, before we started the show, were talking about some of the strength in healthcare names. Now, it has 4 charts in the GalleryView: an intraday chart, a daily chart showing the last year here. We have a weekly chart for me showing the last 5 years, and then a point and figure chart. Now, there are pre-canned versions of this that are already on there, but you can actually create your own, and that's what I've done. So your charts may actually look a little different than mine. The way you do that, at the top of the GalleryView, there's this little message. If you click on Learn How, you basically need to create a couple chart styles with particular names, and our platform will know to look for those, and you can create whatever you like with this GalleryView. Now, what's really cool is if you take 2 tickers separated by a comma, you get what I would call a comparative GalleryView. You want to compare 2 stocks on an apples-to-apples basis, relate one chart's patterns to another chart's patterns, and compare them on an intraday basis, on a daily basis, on a weekly basis. This is the way to do it. This is the classic Coke versus Pepsi, Home Depot versus Lowe's, Stock A versus Stock B. It could be 2 different ETFs, 2 different global indexes, whatever it is, and all you need to do is add the 2 different tickers. A lot of what we would do as institutional investors was all about selecting which stock is better or worse than another. It was never just, should we buy or sell this stock right now? It was, should we buy this one or this other one? And so we looked at views like this excessively. I would encourage you to take some of the names that you're struggling with, take 2 stocks that you're considering in your portfolio, 2 ETFs that you're looking at, put them in this side-by-side view and see how it helps you relate the technical relationships between those 2 very different chart setups. So that's the GalleryView, putting 2 tickers separated by a camera. Earlier today, we mentioned the mystery chart. We showed you this chart here, which has this data series, this price series, price at the top, the relative strength at the bottom. Could you figure out what it is? It is actually this chart right here, XLU. This is the utility sector. This is a bit of an easy one because if you listen to the show, I sort of tried to pick an easier one. We mentioned utilities a number of times today and yesterday. We've revisited this idea of defensive leadership. I thought Mark Newton's comments a little earlier talking about the strength in utilities and the weakness in technology on the longer time frame is really, really important. If you look here, right, the utility sector, and here we can look at the live chart here. You know, over the last couple of years, it's been a nice steady uptrend, but you really haven't outperformed owning utilities, and the reason is because obviously utilities tend to be a lower volatility sector, meaning when the market is in an uptrend, a sector like this is most likely going to underperform because you don't get a lot of price appreciation. They tend to pay a higher dividend, tend to be a little less volatility, less noisy, less offense and more defense. These are, you own utilities usually if you want to not own other things. You're trying to hide out periods of uncertainty or certainly bear market environments. What's very interesting to me when I'm looking at all of the evidence from the market topping November through January, and I would argue in most, by all measures I think are important, the market's really topped out in November. The S&P and the Nasdaq, made a little bit of a higher high with the S&P at the end of the year, but most indicators, breadth indicators, momentum actually topped out in November. Look at how the relative strength was consistently negative on utilities through November, and then it started to change, right? This is what I call a change of character, where we go from a downtrend to an uptrend. Even with this recent pullback that we've seen, the relative strength is still overall making higher highs and higher lows. And now the sector is making a new 52-week high again this week after doing so last week as well. In any environment, this is what I was talking with my guest Mark Newton before we went live on the show. We talked about how while the markets are choppy, using the S&P or the Nasdaq, there's a lot of debate as to how to label a certain move. Is it a bear market rally? Is it a bull market phase? Are we still in a downtrend or now in an uptrend? What levels are most important? At the end of the day, as an equity investor, it's not hard to find stocks that are working. There are plenty of stocks that are breaking out in energy, in financials even, some of the insurance names, and other sectors as well, including utilities and real estate. It's interesting to me that my last two guests yesterday with David Auerbach, today with Mark Newton, we talked about some of these defensive sectors. Even with the market rallying, the guys that I know that are working mainly with institutional investors, people running large funds with a lot of assets, are talking about defensive plays here. They're not talking about jumping into the growthy stuff that's been leading over the last couple of weeks. They're talking about how to use this as an opportunity to potentially get a little more defensive, and I think it's a lesson that should be heard and digested for all of us. So the mystery chart, the XLU, today for the last 2 years. We need to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number one, and actually, sorry, I introduced it too quickly. I didn't actually get my chart up. Here we go. Chart number one is the yield curve. Now, the common way that I've always, for years and years, was taught to track the yield curve was looking at 2s minus 10s, or really it's 10s minus 2s, 10-year yield minus 2-year yield. And so you basically look at the yield on the 10-year versus the yield on the 2-year. If you know the dynamic yield curve function on StockCharts, that gives you a great visualization to show you what the yield curve actually represents and how you look at different maturities and look at the shape of the yield curve. But for banks and a lot of parts of the market, you look at the shape of the yield curve. Is it steepening or flattening over time? What's the relationship between the short end or the shorter maturities versus the long end, the 20, 30-year bonds on the far right side? 2s minus 10s, or 10s minus 2s, that is a great way to show that chart over time. And you can see that the trend is actually coming down, meaning if you look at the 2-year point and the 10-year point, the yield curve is actually flattening. But what's funny is if you change that and look at the 3-month point instead of the 2-year point, the yield curve is actually steepening a little bit. So this is one of those weird times where there's a bit of a disconnect between the 2-year point and the 3-month point. The reason why I'm showing there is the yield curve is flattening and potentially inverting when you use the measure that a lot of institutional investors, and I was certainly taught to do so, but the shape of the yield curve isn't as bad. There really is a much lower side to the early maturities, which I think could mean why financials could do okay, even with the yield curve flattening using that traditional measure. Chart number two is the euro. We rarely look at this chart of the euro. We often look at the UUP, which is a bullish dollar ETF, or $USD, which is the dollar spot index, really the dollar weighted against some other currencies. You flip the dollar chart over, and it's the euro, because the euro is a big weight. It's about 50%, I think, of the U.S. dollar index. And so the dollar chart flipped up on upside down is basically what the euro looks like. I was talking with Dale Pinkert earlier today. He was on our show a number of weeks ago, if I remember right, talked about potential strength in the euro, and he pointed out today you're really seeing the move higher that we had been discussing on his appearance. If you missed that discussion, by the way, I'd encourage you to go back on StockChartsTV.com, check out that episode, and you can see his thesis on what a stronger euro might mean. And to be honest, stronger euro means weaker dollar. Weaker dollar most likely means a headwind for gold prices. Chart number three, the energy sector, and today we're looking at VLO. I just love to keep reinforcing charts that are working, regardless of what you think about whether we're in a bear market rally or you want to label it something different. There are plenty of stocks that are working. I'm not struggling to find stocks making new swing highs. I'm able to find stocks that are making new 52-week highs. I'm finding them in consumer staples. I'm finding them in healthcare. I'm even finding a couple random ones in technology making new swing highs, but I'm definitely finding them in the energy sector. VLO is a great example of the strength in energy stocks, this basing pattern that you saw through much of 2021 resolving to the upside. I would argue these charts are telling you there is renewed strength and potential strength in the energy sector. Folks, that's our show for today. I want to especially thank Mark Newton joining us from FundStrat Global Advisors in New York, sharing his long-term charts on some key sectors. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.